Let's start with an uncomfortable truth. Markets in 2026 are not calm, they are not predictable, and they are not forgiving. We are living in an era of persistent volatility, higher for longer interest rates, rapid technological disruption, geopolitical uncertainty, and shrinking margins for error. The old set it and forget it strategies are under pressure. At the same time, panic driven speculation is more dangerous than ever. So the real question is not, how do I get rich quickly? The real question is, what assets can I own that help me survive, grow, and adapt in 2026? In this video, we'll break down 3 asset categories that play a critical role in a resilient, intelligent investment strategy today. This is not hype. This is not financial entertainment. This is about positioning intelligently for the world we actually live in. Asset number 1, the new role of bonds and diversification. For years, bonds were dismissed. Too boring, too low return, not worth the effort. But 2026 has changed the conversation. Why bonds matter. Again, after a decade of near zero interest rates, bonds now offer something they didn't for a long time: meaningful yield. High-quality bonds now serve 3 critical functions: income generation, portfolio stabilization, capital preservation. In a volatile environment, bonds are no longer dead weight. They are shock absorbers, understanding the new bond landscape. Not all bonds are equal. In 2026, investors must be selective. Key considerations: duration risk, long-term bonds versus short-term, credit quality, investment grade versus high yield, inflation sensitivity. Short to intermediate duration bonds reduce exposure to interest rate swings. High quality issuers reduce default risk. Inflation-protected securities hedge purchasing power. The role of bonds is not to outperform stocks. It is to keep your portfolio functional when stocks misbehave. Diversification is not optional anymore. Diversification is often misunderstood. It does not mean owning everything. It means avoiding dependence on any single outcome. In 2026, diversification works across asset classes, stocks, bonds, commodities, geographies. Risk factors bonds remain a foundational diversifier because they behave differently from equities during stress events. Not always, but often enough to matter. The strategic role of bonds in 2026. Think of bonds as the stabilizing core, the volatility reducer, the emotional anchor. They allow investors to stay invested during downturns, and staying invested is often more important than chasing returns. SSET number 2. Tech, stocks focused on AI and automation. Technology has always shaped markets, but the current wave of AI and automation is different. This is not just faster software. This is structural change. Why AI and automation are not a fad. Artificial intelligence is now embedded in manufacturing, healthcare, finance, logistics. Customer service, cybersecurity automation is no longer optional for companies. It is a competitive necessity. Businesses that fail to adapt lose efficiency. Businesses that adapt gain margin, speed, and scale. That creates long-term investment implications. What tech stocks really means in 2026. In the past, tech investing meant chasing growth at any price. That era is over. In 2026, intelligent tech investing focuses on real earnings, cash flow, scalable platforms, clear use cases. AI is not valuable because it sounds futuristic. It is valuable when it reduces costs, increases output, or improves decision-making. Key areas of focus. Rather than naming specific companies, focus on themes. Infrastructure providers, companies that build the hardware, cloud capacity, and energy systems AI depends on. Enterprise AI platforms, software integrated directly into business operations, automation, and robotics, especially in manufacturing, logistics, and healthcare, cybersecurity, and data integrity. As AI expands, security becomes mission critical, risk management in tech investing. Tech stocks offer growth, they also carry risk. Key principles: avoid overconcentration, balance, growth with valuation discipline, expect volatility. AI-driven markets move fast. Prices can disconnect from fundamentals. The goal is participation with discipline, not blind optimism. Why tech still matters in a balanced portfolio. Technology drives productivity. Productivity drives economic growth. Economic growth supports long-term equity returns. Even in uncertain environments, innovation does not stop. It simply becomes more selective. Asset number 3, physical assets and commodities. When confidence in financial systems weakens, investors historically turn to tangible assets. In 2026, that pattern still holds. The role of gold and silver. Gold and silver are not growth assets. They are monetary insurance. They protect against currency, debasement, systemic risk, loss of confidence in fiat money. Gold does not produce cash flow. Its value comes from scarcity and trust. Silver adds an industrial component linked to energy and technology. Why physical assets still matter. Physical assets exist outside the financial system, cannot be printed, are globally recognized stores of value. They do not replace productive assets, they complement them. In periods of extreme stress, they often behave differently than stocks and bonds. Real estate in a 2026 context. Real estate deserves nuance. It is not universally good or bad. Key considerations: interest rates, local supply and demand, rental yields, maintenance, and liquidity. In 2026, real estate is less about speculation and more about cash flow and utility. Rental income, inflation-linked pricing, long-term demographic trends. Not all markets will perform equally. Commodities beyond precious metals. Other commodities also matter. Energy, industrial metals, agricultural products they are sensitive to. Global growth, supply chain disruptions, geopolitical events. Commodities add diversification but require careful allocation due to volatility. Putting it all together, a resilient framework. The key takeaway is not to chase the best asset. There is no single winning asset in every environment. The goal is balance with intention. A resilient portfolio in 2026 uses bonds for stability, uses tech equities for growth, uses physical assets for protection. Each asset plays a role. Each offsets the weaknesses of the others. Common mistakes to avoid. Before we conclude, let's address what not to do. Overreacting to headlines. Chasing short-term performance. Ignoring risk management. Betting everything on one narrative. Markets reward patience more often than prediction. 026 is not an easy year to invest, but it is a clear year. The rules are visible. Volatility is normal. Diversification is essential. Fundamentals matter again. The investors who succeed will not be the loudest. They will be the most disciplined. They will own assets with purpose. Accept uncertainty, manage risk intelligently. If this breakdown helped you think more clearly about investing, like the video, subscribe for professional, unbiased market analysis. Comment below which asset you're studying more deeply in 2026, because intelligent investing is not about predicting the future, it's about being prepared for it.